Before you set up your next automated Bitcoin buy, I need you to watch this because the dollar cost average information advice on the internet was built for small investors. And if you're putting serious capital to work where you're talking $10,000, $20,000, $50,000 plus you're looking to put in the market, the rules are completely different. The tax implications alone could change your net return by 6 figures. This is something that I've been working with our clients and people across the world for the last 8 years of being in crypto. I've taught thousands of people, have over 120,000 followers online where I teach these principles for high net worth and sophisticated investors because it is not the same. Now, if we look at a basic chart, the normal dollar cost averaging strategy does work, all right? You can see here, if you're just investing $5,000 a month and you accumulate for 3, if you go 4 years, you can see the outpace of growth against, gold or the S&P is massive, right? You get that really big growth. But the thing that people don't talk about is the strategy that you want to be able to take when the market has retracements. When Bitcoin goes through periods of volatility, there is bigger opportunity than when the market is in a raging bull market. What I like to implement and what we teach is a range of dollar cost averaging that strengthens and increases the amount we purchase based on retracements in the market. So instead of just having a flat dollar cost averaging where you're just buying $100 a week as an example over a period of time, or $1,000 a week or $10,000 a month, whatever it is, we like to increase our buys as we get towards certain ranges and metrics based on what the market's doing. So the 200-week moving average as an example is a really, really simple way to see the structure and previous bottoms of Bitcoin cycles. And you can see when we hit these ranges, there's only been a little bit of time in 2015 and also in 2023 where Bitcoin stayed below that 200-week moving average. As we go towards that 200-week moving average, we like to increase the amount of Bitcoin we're buying when we hit those ranges. When we hit these peaks, when we really push up and we have larger bull markets, obviously you want to back off those buys and not have the same amount of purchases, but that's actually what most people do. They increase their buys when the market goes up because they get confidence and they reduce it on the way down. That's obviously the wrong thing to do, but crypto and Bitcoin and digital assets creates this fear and creates a really difficult environment to have confidence and accumulate more when the market goes down, so you keep a simple basic strategy. What I want to help you understand is that what we really want to look at is drawing down based on increase of the baseline amount and having predefined top-up rules. So one of the things you need to have is obviously extra cash on the sidelines, but what we want to be able to do is increase our Bitcoin buys when we have those retracements. That's number one. The next chart I like to look at when looking at when do I increase my Bitcoin buys is the MVRV ratio. This is a market value to realized value ratio, which every single time from the existence of Bitcoin has really marked the bottom of cycles. When the market is down 30, 40, 50%, I'm increasing my buys, but I'm also looking at when the market may look to return. So the realized value is the amount of existing Bitcoin purchases and the value that they have those purchases at. And then you've got the market cap or the actual value of Bitcoin, which is the price that Bitcoin pays. When you get this ratio down here in this green area, you're getting a ratio that signals to the market that there is far less people in profit and far few people that are willing or likely to sell, which tends to increase the likelihood of the Bitcoin market bottoming. The lower we get to this green range here, the more I'm also accumulating my Bitcoin purchases. The higher of this range, obviously, I'm decreasing my purchases there as well. That gives me a really good fundamental stance of, okay, this is now getting higher value and ROI on my dollar. And also I want to be able to look at my broader net worth and go, how much do I want to implement and how much do I want to buy based on these ranges? One of the things that a lot of people get stuck into when putting together their investment strategy, Bitcoin and digital assets, is that they look at through it a lens of how much money do I throw at this coin? I've got $1,000, what do I buy? I've got $100,000, what do I buy? Rather than thinking about it as a more broader net worth strategy. The way I like to look at it is if you've got 100% of your net worth right now not allocated to Bitcoin and digital assets, what is your target investment range? Bank of America advises 4 to 5%. Depending on your risk appetite, that will change. For me, it's a lot higher as I'm in a wealth creation mode and I've got a little bit more risk to play. If you're in retirement or you're looking to increase the amount of capital you have ready for retirement, maybe you've got less risk and you're not going too heavy on the other cryptocurrencies, but you're going heavier on Bitcoin, that is going to give you a percentage allocation. So the target range of how much Bitcoin or digital assets do you want to own in your net worth? Let's say it's 10%. Let's say your net worth is $10 million. Okay, your target investment is to get to $1 million of Bitcoin. Now, obviously you're not going to go and put that all in at once, but what I see time and time again, when we start to get clients that come in and work with us, is that they have tried to do this themselves. They get very excited when the market goes up and they buy higher amounts of Bitcoin at higher ranges. Let's say you bought at $110,000 Bitcoin or $120,000 worth of Bitcoin. When the market retraces, you get fearful and now you're not buying more, you're trying to wait for the perfect bottom. But by waiting for this perfect bottom, you're essentially not taking advantage of this accumulation range where Bitcoin chops sideways for a period of time. I'll show you this chart. So there's 4 parts of a crypto market cycle. You've got accumulation, growth, bubble, and crash. Now, during these ranges of accumulation, this is where you want to be dollar cost averaging and increasing your buys. It's usually when the market's down 30, 40, 50%, sometimes even 80%. And that tends to be around ranges where we're hitting this 200-week moving average, where we are right now, and also where we start to hit the MB/RV ratio of lower this green range. This is where I'm increasing my buys because we're in that accumulation range. We're in that right now. So anywhere below this range, I'm accumulating. I think it's a great time to accumulate now, and this is where we're increasing our buys. But as we go through, in the moment, it's very hard to think and realize that actually this is the right time to buy because we're waiting for a perfect bottom. We're waiting for a V-shaped recovery, but that doesn't tend to happen. We always see in crypto U-shaped recoveries, and we see these ranges where we chop up and down based on whatever the market's doing. Usually in these ranges, we have anywhere from 6 months to 18 months of an accumulation period based on the current market and the way we had a big sell-off late last year. I expect us to probably range here for, up to 12 months. We've currently been accumulating here for maybe 3 or 4 months right now. And around this 200-week moving average, this is a perfect time to accumulate. This is where I'm increasing my buys. So let's say I'm trying to get to 10% of my net worth in Bitcoin. This is where I'm increasing that. If you're already bought previously at higher prices, now you're looking at a game of how can I reduce my average buy price. So if my average buy price of Bitcoin is $110,000, how can I reduce that to decrease that so we get more upside when the market returns? With Bitcoin and crypto, ultimately it is a liquid asset. It moves ahead of other markets. Right now with the global uncertainty, the market is in a risk-off position, but that doesn't change the value of Bitcoin. Bitcoin is the same asset as it was at 120,000. Bitcoin is not a company. It doesn't have less revenue or less EBITDA or less profit. It is still the same asset. It's digital gold. And we see institutions buying and doing that same strategy. In fact, MicroStrategy is the best example of dollar cost averaging in Bitcoin. You can see how much Bitcoin they've been accumulating here at different ranges, and it's not always consistent. It's not the same every single time, but they will look to increase their buys at certain periods where we get market retracements, like we are in right now. They recently bought another 13,000 Bitcoin at that $71,000 range. So being able to accumulate at these periods is a far better strategy than only getting too confident buying near the top. Now, to do that though, you really need to have conviction. This is the second part of our 8-step strategy we teach, is that Bitcoin thesis is not just another digital asset. Bitcoin is that core asset. It's got true decentralization. And the long-term view is that every panic, every Bitcoin is dead headline always returns that recovery to new highs. And that same pattern is repeated 2020, 2014, 2018, 2022 and beyond. And even a small allocation is really going to help. And that dollar cost averaging strategy removes the emotion, but we want to hold Bitcoin for a long period of time. Bitcoin is the core part of our digital asset strategy. And then we trade altcoins around the outside of that, as data continues to show that just people who buy and hold Bitcoin for a long period of time continue to outperform the entire market. We then add in altcoins in different periods of the market because they allow us to increase the amount of returns we have. And my ultimate goal is to buy altcoins, sell them down, and then buy more Bitcoin. That's the only reason I hold altcoins, but you've got to be more timely. We'll talk about that in another video. But the real core part about just starting out with your Bitcoin allocation is really, what is your target allocation for your net worth? What are your rules when it comes to increasing your top-up rules when we get from recent highs? And then do you have that cash reserves ready to go? Now, when it comes to buying and selling as a high net worth investor, this is again what makes it different from a normal dollar cost averaging strategy, is that there is a lot of friction when it comes to investing a lot of money. And also, if you have the wrong exchange, you can lose a lot of money to fees, spreads, liquidation, and also illiquidity. And also just generally these exchanges are taking you for a ride in terms of the spreads they offer as well. So really the first one is, I always like to push my cash from my bank account into the crypto exchange to begin with and hold that capital there in stable coins. Why? Well, banks have friction. Depending on where your locations are, banks don't like Bitcoin or crypto. They don't want you to move your cash onto these platforms because it's taking it away from them. So I like to first, number one, move that capital into a stable coin like USDC or USDT, and you can hold that on the exchange. Now, by doing that as well, you're able to get instantly access to the markets and buy Bitcoin or crypto very quickly, and you can sell those USDC or USDT stablecoins into Bitcoin. The other thing about doing that is that we can start to earn a yield or an income on our stablecoins. So that's what I do right now. I have a lot of my portfolio in USDC on a platform called Syrup, where I'm earning up to 6, 10, 12% per year, depending on the day of the week. It changes based on a few different parameters of the amount of people that are using those stablecoins to lend. And I'm able to earn passive income while I'm waiting to add that money into the market. And it's a lot higher than I'm getting in the bank. So that's the second reason I like to have it into the crypto exchange. The third one is that you need to be able to choose the right exchange. So for example, you might be trading on Coinbase. Coinbase is very easy, solid choice, but you're going to pay a lot higher in fees, all right? Using or signing up to something like Coinbase One, I think it's $30, $40 a month, allows you to reduce your overall fees. Crypto and Bitcoin exchanges are essentially brokerages, and they make money by a couple of ways. One is charging you a fee on the transaction, but usually these exchanges will hide those fees and say, zero fee trading and charge you a spread. And the spread is the rate that they are selling you these assets for and the rate that they're buying them for. And they make a margin on the middle. And that is where you can lose a sizable amount of money. If you're transacting 10, 50, 100,000, $1 million. I had clients that recently were trading in the upwards of $3 or $4 million on an exchange where they were not realizing that they were charging up to a 3% spread on every single transaction. They were losing tens of thousands, hundreds of thousands of dollars in those transactions. So a really good way to be able to track that, you can use a platform called Sum, which was formerly Crypto Tax Calculator. This is a tax calculation platform, but it also is a great way where you can see the amount of fees you're paying. You just plug in your exchanges and your wallets into Sum. It's got a read-only access, and you can see all of your portfolio, the transactions, the fees, the amount you've invested, your gains, etc. And you can see what those exchanges are taking from you. I recommend using Coinbase is great, Kraken is great, but make sure you're looking to use their pro accounts as it can save you a lot of money. If you're in Australia, SwiftX is great, CoinSpot are great. OTC features are really, really important as well. And as a sophisticated investor, using OTC, which stands for over-the-counter trading, allows you again to get the best rates and the best fees available rather than going directly through the exchange. If you're buying directly through the exchange, that is where you're going to pay the highest fees, and over-the-counter trading is far greater experience to be able to get lower rates. And you can then set up your dollar cost averaging automation and recurring buys through those exchanges or through the over-the-counter trading options you have available. Again, Kraken and Coinbase are great, and most exchanges now have the automated dollar cost averaging strategy. If you, by the way, want to get your own wealth protection blueprint, we've got the screen I'm sharing here is our full training. It's free. It's a personalized framework that you fill out a few questions, takes about 3 minutes, and gives you a personalized breakdown of exactly how and where you should be, positioning your digital asset portfolio. Complete personalized blueprint takes 3 minutes. I'll put the link in the description below. The next part I want to talk about is rebalancing and the frequency that you do that as part of your portfolio. One of the misunderstood things in Bitcoin and cryptocurrency is that there are so many different coins, there's so many different assets that you want to be able to rebalance and restructure quite regularly to ensure that you are building a portfolio that is structurally sound and you're not over allocating to different coins or projects. So when you start to build in altcoins into your portfolio, you'll see here on this chart in the blue, you've got the others, which is the altcoin returns outside of the top 10, basically the altcoin market cap. And in the bar chart, you've got Bitcoin. As you can see in the blue, in certain periods, altcoins will track the growth of Bitcoin. But what tends to happen is altcoins are like leverage positions. So when Bitcoin's moving to the upside, altcoins will outperform, but on the downside, altcoins will really, really underperform. And what's really important is that you rebalance and restructure your portfolio at certain periods of the market to not be over allocated in altcoins when the market starts to go down. One of the rules that we really abide by in Collective Shift is to really ensure that as part of your frameworks and building your thesis in your portfolio is that you have a really solid amount of Bitcoin, because Bitcoin really is the, as I said before, the digital gold. But the market cycles, when we hit the correction period, is that the cycle is resetting. You don't want to have a large amount of altcoins in your portfolio. So again, if you're dollar cost averaging into assets like altcoins or Ethereum or Solana or whatever that may be, you want to be able to make sure that when we have those corrections, you are utilizing those periods of time to maximum upside, but you're also being able to take profits and ensure that in these growth and euphoria stage, you are not just sitting and holding. If you're sitting and holding and not doing anything with those altcoins, then you're ultimately just waiting for an implosion to occur and you're not actually taking profits off the table. So the dollar cost average strategy is really important on a timing basis, but also you need to be able to take profits off the table at certain periods of the market as well. And that's when it comes to the sell strategy, which we'll talk about in another video. But the tax component for high net worths, when you are taking profits and you are, moving assets around, it can trigger tax events. One of the things that's really important is that when you're swapping coins, that is a taxable event, and you really want to make sure that you are recording everything when you're doing so, or using a platform like Sum that does it for you. Now, one of the tax strategies I have as a dollar cost average strategy is that I like to accumulate most of my capital in Bitcoin and then obviously not sell my Bitcoin. I then lend against my Bitcoin to then allow me to not have to sell and trigger a capital gains event, and that ultimately allows me to take debt out against my Bitcoin at, depending on what the rate is, 7 or 8%. I can then cash flow, and then I can pay back that Bitcoin with growth of the asset or just income I have externally, and I still have exposure to Bitcoin without paying the tax. That is a really big part of my strategy, and it allows me as a high net worth investor to not pay consistent capital gains tax. If you're moving your assets around, you're constantly buying and selling and you're swapping, you are going to have tax implications. It's really important that you know that, and that's why having a tax strategy is really, really important as well. Another thing you can do is the structure of your assets, making sure they're in tax efficient structures in different parts of the world you can hold for periods of time and get tax discounts. You can also look to buy in your 401k account, your SMSF account if you're in Australia. Again, chat to your tax accountant. We're not a tax agent by any stretch of the imagination, but from experience shares and working with a lot of clients, using retirement accounts, company accounts can reduce your tax implications. I personally have mine now in a company structure because I can move my income and buy using pre-tax dollars with my dollar cost averaging strategy, so I can get allocation to capital quicker versus paying the tax now and only having the remaining to deploy to the market. I pay that tax down the line and I get all that capital to dollar cost average immediately. So that is a really big part of that strategy. And it's really coming back to that point of why, the differentiation is different for Bitcoin holders. If you're high net worth, is that if you are just flat investing and you are making the same investments at the same time all year round, all market round, you are not able to take the increase opportunity of when we are at these periods of pullback and correction that will continue to happen in crypto because it's part of the market, part of the native cycle. So build those rules. As the market decreases 20, 30, 40%, increase your buys by those periods, have a logical rule, execute it, and that is how you're going to continue to grow at a faster rate versus others that have a simple dollar cost average strategy in Bitcoin. If you want that blueprint, go check it out in the link below. It's a free blueprint. You'll get all of the 8-step strategy I just shared and an exclusive video that we put together. Fill out that form and you get a personalized blueprint in your inbox. Thank you so much for watching. Please watch if any of the other topics I spoke about on my channel. I've got lots of other videos you can check out. Otherwise, I'll see you on the next one.